In the previous video, we talked about cheap money. We discussed how cheap money was responsible for creating zombie companies, and we also had a debate on whether zombie companies were important for maintaining the economic stability or they were just slow poisons for the economy. But today, we'll be taking it a step forward as well. We'll be talking about something that Wall Street calls the closest thing to free money, and that is called carry trade, which is actually quite simple. What happens in carry trade is basically we borrow at wherever the money is cheap, and we take that money and we invest it where money helps in earning more. Let's say there's a country A who is giving out loans at 1% interest rate, and let's say we are talking about country B who have investment opportunities in terms of anything bonds or interest rates revolves around 8%. We'll take that money from country A and invest in country B, and what basically happens is the 7% spread which eventually becomes profit, right? There's such a simple math, but don't you think the maths is too good for that? If it's that easy, why isn't everyone rich? Because hidden behind those profits are basically the risk that has bankrupted the traders, destroyed hedge funds, and actually shaken entire economies. Right? So, before that, let's talk about the price of money. See, money is not cheap, neither it's free. What do I mean by that? Let's say you need money. What you can do? You can either work for it, but it will take time. You'll get your salary after a month. You can invest it somewhere, right? But you'll get the return after 1 year. Plus, you need actual money to invest in that particular thing. So, everything, if you want to earn money, it takes time, it takes hard work, it needs discipline, right? What if you need it now? You can get it. How? Interest rates, right? It's as simple as that. So there comes the fact, money is expensive but not everywhere. It depends on the economic environment of that particular country, right? So money has a price. It's called interest rate. In a country where the economy might not be as good as it should be, the government is basically trying to make sure all their decisions are based on people actually spending so that they can increase the cash flow of money in the economy so that the economy blooms. So what's the best thing to do? That lower down the interest rates, bring it to close to zero figure, let's say 2% in this particular scenario. You'll get loan at such a low interest cost, right? Talking about an economy where everything is blooming, it's doing good, we have to maintain so that there is no increased inflation. We have to maintain inflation as well. So in that particular country, what would happen is the interest rates would be much higher, right? But we are missing one underlying factor here. See what is happening in country A. Let's talk, name this country A and name this country B. What is happening here is, if the interest rate is 2%, let's say the saving or the investment rate available would be less than 2%, let's say 1%, right? What would be the scenario here? If the loan is out for 10%, right, cost of borrowing for bank would be high as well. So investment or saving rates would be approximately 8%. What if we borrow from this country, take the fund and invest in this country, right? This seems to be a viable solution, right? Now this is what it would look like. We borrow at 1% from country A, invest at 8%, we keep the difference, and everything is good. We don't have to wait and basically make ourselves grow to the harsh reality of stock market rally. We don't have to wait for any real estate boom. We just have to benefit from the interest rates the difference between the interest rate of two countries. We just have to take the money from one place, put it in one place, and we'll be rich, right? And that's why smart money loved it. Institutions like maybe hedge funds, banks, pension funds, they're often searching for yields that are constant and stable, right? Banks are in steady need for returns on deposits and reserves. Hedge funds are always on their toes to make sure they are delivering alphas and beat the benchmarks for clients. Pension funds are obligated for long term, obligated to long term retirees, right? So why it looks very attractive is, let's say, a simple fund size of 100 crore rupees, which is quite small for these institutions, right? What is happening is, if the carry spread is 5%, annual profit alone is 5 crores, and without even lifting a finger, right? Suddenly this isn't a pocket change. When thousands of institutions think this way, capital begins to move around the world. Now what is happening? You're not the only one who is taking advantage of the system. The money is actually flowing through the entire economy, right? Everybody is using these tactics, right? And everyone is trying to make money out of it. Don't you think that something is off with that? We'll figure it out later, right? Before the aftermath of what will happen with carry trade, let's talk about the greed of the investors. The most investors who are greedy enough are addicted to leverage, right? And leverage helps to amplify the returns, but we have learned in so many videos now that leverage has its upside downs, and as much as gains it is willing to provide, it can also be something that can bring you to the streets, right? So without leverage, you have a capital of 10 lakh rupees. That 10 lakh rupees is in your hand. A return of 5% with a mere 50,000 rupees profit, good return, it is respectable, right? Now comes leverage. There comes greed. You have 10 lakhs, you want to borrow 90 lakhs and want to make your position 1 crore. But with 5%, with 10 lakh rupees of your capital, you're earning 5 lakh rupees, 10 times the more profit, right? This looks very attractive, right? Leverage is a double edged sword. Carry trades become addictive because leverage transport small, enormous spreads into enormous profit. But on the same way, losses would also be multiplied 10x, 20x, and many, many more. Right? The same force that creates fortunes can detonate entire portfolios in days. Right? But here comes some biggest problems. I asked you a question. Why isn't everyone rich now? Why did it bankrupted the investors? Right? What actually happens is the currency risk. See, when we were talking so gladly about this particular scenario here, what we fail to ignore is exchange rate. We were looking through this slide with such confidence that we fail to notice this. And the problem with exchange rate is it varies according to the supply and demand of that particular currency as well. When major institutions are trying to come into picture and profit from the arbitrage, what is happening here? The demand would increase for that particular country, right? The exchange rate would be affected. So we are first borrowing from this, converting into this, then realizing a profit and then paying them back. So much exchange is happening here. The exchange rate is bound to reflect this change. What will happen? Your leverage, leave alone leverage, the 5% currency, if it moves against you, will make your 1 year profit which was so attractive on paper, would be erased in seconds. Right? In seconds. See, here what 5% is easily achievable. Why? Because it is from both the currencies. You have to convert both the currencies that you are dealing with. And if you are dealing outside the domestic currency, then three currencies come into picture. Right? So volatility in terms of currency rate fluctuation is very high. It could erase you, it can bring you to zero. Imagine you earned a 50,000 profit, you lost it to currency, you have interest on leverage that you took, leave alone the 10x profit that you had because of leverage. This is why it is so dangerous. This is why it was capable enough to bankrupt investors. Investors spend years collecting small gains, then one currency move wipes them out. Right? So it doesn't only happen with bonds or small investments or saving investments. What actually happens is we carry currency. We borrow one currency, invest in another currency, then this is basically the most famous one. So you are basically betting on the fluctuations and the interest rates of currency carry. But again, here we also have to make sure we understand the concept of transaction cost. Alright, then we have the bond carry. What we do is we understand in the yield curve video that bond rates tend to go like this. This is the maturity, this is the interest rates, right? This is the interest rates. Short terms give smaller interest rates, long term give high interest rates. So basically we borrow from short term at low rates and then we buy the long term bonds for high yield. We borrow cheap money and then we buy dividend paying stocks with higher yields, right? So dividends could be helping in interest payments, maybe in some way or the another you might be gaining from that as well. Also comes the capital appreciation, but dividend attracts tax. Appreciation when realized attracts tax. Plus when you are buying equity, it encloses transaction cost, platform fees, and many broker fees as well. Right? We are basically taking advantage of commodity. We are we are using financing advantage to profit from commodity inventory spread. So this is also how carry trade is coming into picture in all the assets. So we'll talk about four countries basically who are known in the domain of carry trade. So we'll be talking about Australia. For years, Australia was offering higher interest rates than many developed countries. Investors loved Australian carry trades. Capital flowed in steadily. So this was a prime example why not every carry trade ends badly. But there comes Iceland. Iceland's once offered extremely attractive yields. The global money poured in. The risk eventually became obvious when the currency instability hit hard. See, this currency instability, na, this is what is making it very difficult to trust. When we are talking about carry trade, we have to make a fixed assumption that the currency is stable. Stability is the first thing. See, what volatility in currency is doing is actually eating out your gains. There could be a chance of favorable conditioning of the change in foreign exchange, but taking when we are taking so much positive inputs on one place, we have to see the negatives of it as well, right? So higher returns often hide higher risk. So high interest rate countries attract massive capital inflows. This strengthens their currency until it doesn't. When the tide turns, the rush for exit can be brutal. It's always a game of entering at the right time and leaving at the right time. You should be knowledgeable and disciplined about it. Only and only then you'll be able to make money. You should just blindly make any move. All the moves should be well calculated. What happened in Turkey was Turkey frequently attracted carry traders with very high interest rates. The yield were enormous and the risk from the currency volatility was enormous as well. The best known example, Japan. Japan is the most famous carry trade story, and we have talked about three more as well. Right? So, every carry trade is a bet on stability. When stability holds, steady profits flow. When stability breaks, years of gains can vanish overnight. So stability is such a underlying factor which we tend to ignore most of the times. We have to see the big picture. How can we see that? Talking about the micro, meso, and macro environment. This slide in every one of my videos is really important because understanding from the one person perspective to the macro level environment, we also need a middle ground to connect those dots, right? So this is basically a step by step build up or what is happening to the economy because of the underlying investment techniques like carry trade. So for one trader, carry trade is an income strategy, a way to generate steady returns from interest rate differentials. As simple as that. It's not harmful to the economy. You're just making benefit of the arbitrage, right? In the meso environment, what is happening is for market it becomes a capital flow story, right? For one person, if money is exchanging, talking about the markets, it's a capital flow story. Billions are moving across borders chasing yields. Everybody is trying to make sure they profit from that arbitrage, right? Which is affecting exchange rate and asset prices. Now comes the global picture. For economies, it affects currencies because there is so much of increase in demand and supply of various currencies, interest rates, asset prices, financial stability. Central bank must be quick enough to respond to these flows of that particular countries. Right? So this is basically the 7% interest rate of spread profit was just an iceberg, the only visible part. Currency fluctuation is something that we tend to ignore. Leverage amplification is the result of your greed. If you are, see, again, it's not always greed when you are taking leverage, it's greed when you are taking uninformed decisions and just looking at the profit and only taking leverage because it amplifies your gain. You have to make assumptions about your downside as well, right? So liquidity crisis could occur. There could be policy change that could dramatically change and result in currency fluctuation. It could create market panics as well, right? So carry trades don't make money from intelligence. The basic tool that you need for carry trades is stability. The moment stability disappears, years of easy profit can disappear with it, right? So small gains and hidden risks have massive consequences. A carry trade is fundamentally a bet that the world will remain stable. The profit come from interest rate differences, but the real risk come from everything else. Now you know the hidden inner working of the strategy that secretly controls trillions of dollars of global capital flows and exactly why it works until it doesn't. If you want to understand the actual macro mechanics that move markets, hit that subscribe button right now. Drop a comment below on whether you think the yen carry trade is a tricky time bomb, or I'll see you in the next session.